Hi, my name's Nick Godfrey. I'm a life and health insurance broker with a specialty in estate planning and business succession. So I've got lots of experience in the corporate world and tax planning. So today we're going to talk about the tax benefits of corporate-owned life insurance. Let me share my screen and we'll jump right in. So there we are, the tax benefits of corporate-owned life insurance. So there are really only a few ways of getting money out of a corporation. Certainly one of the most common is salary. People will T4 themselves and provide an income. And the reason they like to do that is so that they can then make contributions to an RSP, Canada Protection Plan, or make pension plan contributions. For those who are less interested in those sorts of tools, then you can also just pay dividends. It has a lower tax rate, personal tax rate, and it is progressive, so it increases over time. But what we're going to talk about mostly today is the capital dividend account. And it's the capital dividend account where the tax-free portion of capital gains flows out. So as perhaps you're aware, when somebody realizes a capital gain, which is the difference between what they bought something for and then what they sold it, difference between that is a capital gain, and only half of it is taxable. The other half is not taxed, and it's that tax-free portion that can flow out of a corporation through its capital dividend account. Life insurance proceeds, because they're tax-free, they too flow out through the capital dividend account. Less any adjusted cost base. Now that's a bit technical, but we can worry about that later, but I just wanted to be clear that not 100% of the proceeds may flow through the capital dividend account tax-free. So when people have investments within a corporation, there are these new passive income rules that the government came out with just recently. It creates a new layer of taxation for some people, but one way to avoid those new passive income rules is have investments within the corporation, like individual pension plans, retirement compensation arrangements, and what we're focused on today, corporate-owned life insurance. So there are really three levels of taxation when people are dealing with this kind of estate planning. So upon death, there's going to be a personal tax return, and taxes will be paid there. Within a corporation, there could be some realized capital gains or income taxes there. And then the third one is estate taxes, which really refers to probate fees that are levied by the province in getting a person's estate cleared for probate. When we talk about assets and estate planning, really we talk about the registered savings plans, which are RSPs and RIFs, RIFs we call them, the retirement income funds. But people also own non-registered savings, different kinds of investments, stocks, mutual funds. And then the third one, which we're talking about mostly today, is money that's contained in a corporate environment, corporate savings. And the reason a lot of people like to do that is that there's a lower corporate tax rate, and so the more money they leave in the corporation, the better tax deferral they get. So what to spend first if you're starting to do your income and estate planning? Really what we recommend is that you spend your registered and non-registered money first and take advantage of the corporate tax deferral. So leave that money in your corporation as long as possible, and that's a good tax strategy. So one of the questions we start to ask is, do you have sufficient retired, registered, and non-registered funds? Do you have enough money to meet your or even exceed your projected retirement income needs? And if the answer to that question is yes, then you need to start to consider putting your corporate funds into this tax-sheltered life insurance policy as an estate planning strategy. So why are people putting money in a corporate-owned life insurance policy? Well, they're going to use the death benefit to pay capital gains taxes on death. They're going to use it for estate equalization. Well, what does that mean? It means that if people were to have more than one child, let's say there's a business or a cottage, they want one child to get the cottage, then the other child will get cash. So the insurance is a form of liquidity of money to equalize the estate. One of the things that's really important is it does remove a layer of corporate taxation, and we'll show you how that works. Again, it's not affected by these new passive income rules, so it's an important planning tool. And lastly, the lower after-tax cost of premiums when paid corporately makes the insurance just simply that much more affordable. So what's it look like? So you've got money in a corporation. The corporation is going to be wound down because the shareholders are no longer living. The money is going to flow out through through a taxable dividend account. You're looking at a top rate of around 47% right now, and whatever's left, you're going to see will end up with the beneficiaries. So that's if you do nothing. However, if you look at putting money in a corporate tax-sheltered life insurance policy, essentially you bypass the tax man and send the money down to the beneficiaries. It's much more tax efficient. So here's an example. Mr. and Mrs. B, 75 years old is she, and 78 years old is he. It is Mrs. B who is insurable. $3 million in a professional corporation. They own their non-registered and registered investments. So what we're going to do first is we're just going to say let's do nothing and see what that looks like. So if we don't buy insurance, so we've got $3 million. You can see here if we invested it at 3% net for 15 years, we'd end up with $4.6 million. So if that money flows out, you're going to look at over almost $2.2 million in tax, and you've got $2.4 million going out to the beneficiaries. It's a big tax bill. Remember that number, 2.477 to the beneficiaries. So let's say rather than doing that, we start to move the money into a life insurance policy. We're going to put it on Mrs. B because she's insurable and age 75, and we're going to put $300,000 a year for 10 years because there's $3 million in the corporation. You don't have to put it all in, but this is just an example. If you were to do that, a 75-year-old female non-smoker would qualify for a policy of $1.974 million. We will use what we call a participating whole life policy. It uses paid up additions, and we're going to illustrate the current dividend scale. I know that's confusing if you're not up to speed on whole life insurance, but we can explain that in a side meeting. So how's it going to look? Well, what happens is that we start with that $1.74 million. We put $300,000 a year in for 10 years. And at year 15, that policy has grown from the 1.9 up to the $3.759 million. Sufficient growth. Now, the adjusted cost base, this is the amount of money that needs to come out as a taxable dividend. So what we do is we pay the tax on the 1.717 million, and we get net proceeds of $910,000. We add that to the tax-free portion, and you can see we were at 2.4 million before. Now we're at closer to 3 million, 2.9, so $500,000 more is going to come out to beneficiaries using the life insurance. The other thing we can do is examine the money that's within the policy. So when you pay the premiums into the policy, it doesn't disappear. It sits in there, and it's called cash surrender value. After 10 years, you can see that there's almost $2 million in there. After 15 years, there's almost 2.2 million. Year 20, and at year 100, there's over $4 million of cash within the policy. The point I'm trying to make here is not that it's a huge amount of money in there, but that it's there, and that if the policy owners need to access it, there's cash there for them to pull out and add to their retirement income. So again, the strategy review. So you draw down on your registered and your non-registered assets first. You let the corporate assets grow tax deferred in a whole life insurance policy. You're able to access the cash value in future years if you need it, and the death benefit flows out through the capital dividend account on a tax-free basis, less the adjusted cost base. And you can see in our example, there's an extra $500,000 that will go tax-free to the beneficiaries if you can do this strategy. So in summary, it's really easy. The ease of administration policies, you're only be looking at one in this case, but they're very easy to administer. Fewer pre-tax dollars, so it's cheaper by using corporate tax dollars to fund this than personal tax dollars. And all of the premium, not that it applies, I think, in your case, but all or part of the premium can be deducted for tax purposes if the policy is required for collateral. And then the last one, the death benefit less the adjusted cost base can flow through the corporation's capital dividend account on a tax-free basis and be paid to the shareholders or the shareholders' estate. So that's nice. So the disadvantages are that there's no creditor protection. I don't think that really matters in this case, but the corporation is only the beneficiary. So it's important to set this up with the corporation owning the policy and the corporation being the beneficiary. You don't want any taxable shareholder benefit. The cash surrender value could affect the qualified small business corporation status for purposes of an enhanced capital gain. This really applies to operating companies, not really investment companies, so I don't think that applies. And the policy gains and taxable income can arise if you were to ever transfer the policy out of the corporation. So that's really the last kind of disadvantage. So who's this work for the best? Again, it's for people who've got non-registered and registered assets, money, and it's sufficient to meet their income needs, and the money that's in the corporation, they can just let it ride. So they want those corporate assets to just continue to grow. The corporate assets, certainly in the short term, are not required for personal income needs. And really, it's the goal of the owner, the corporate owners, the shareholders, that they want to take advantage of this corporate tax deferral. They want to avoid this new passive income problem. They'd like to remove a layer of taxation and bypass the tax man. We all like to do that. And maximize their estate. Really, it's an estate maximization strategy, and it creates a flexible source of tax-sheltered funds that you can draw on later. And one of the keys here is that the people need to be insurable. At least one of them. One of the shareholders needs to be insurable to make this work. So thanks very much for your time today. Happy to answer any questions. I know we're quick going around what the adjusted cost base was, and I do have illustrations to show you kind of how they work, and we can have a deeper dive if in fact you've got more interest there. Thanks very much for your time. You know where to reach me, I hope. Thanks. Bye-bye.